This is Horizons, Middle East and Africa. Our top stories this morning. Asian stocks fall after softer Chinese data and as traders look to Friday's U.S. jobs report. The latest Fed minutes show officials eager to slow the pace of rate cuts. A Bloomberg scoop, the Biden administration is set to further limit exports of Nvidia and AMD AI chips in a final salvo against China's tech ambitions. Plus, Lebanese lawmakers will try to elect their first president in more than 2 years. It's just gone 8 a.m. across the Emirates. I'm Christine Burke in Dubai in for Jumana Bersechi. Well, good morning. Let's get a look at these markets because it is pretty clear that investors are on edge as we consider the path of interest rates, inflation, Donald Trump's policies, and of course, where government spending and borrowing goes in the year ahead. We had a broad-based sell-off in global bond markets yesterday that yanked around yields not only for the treasuries market, but also in the UK and in Japan as well. When we consider how U.S. equities performed, it was a choppy session yesterday on Wall Street. The S&P 500 and the NASDAQ ultimately closing in different directions. Taking a look at where we are standing this morning, U.S. equity futures are still under pressure. And just note that we do have U.S. stock markets closed today as the U.S. will have the president or have the funeral for President Jimmy Carter. Now, when we look at the U.S. Treasuries market, the 10-year yield has come back down a little bit, but it is still hovering around 4.7%. So we're talking about really elevated levels. The U.S. 20-year yield as well. That was the first part of the Treasury's yield curve yesterday to pop above 5%. Now let's talk more about bond volatility because yesterday we saw some aggressive moves as I've just been mentioning. But this chart here shows you that we've also seen volatility in the bond market move higher. So you can see the MOVE index there has popped higher to the highest levels since November. So really just underscores that we are seeing traders on edge, a bit of jitters in this market. Now let's get over to Asia now and check in on how markets are faring there because we got some data this morning and Avril Hong is going to tell us all about how the markets are reacting. Avril?
Yeah, we're seeing China, right, on the consumer inflation front, that continued weakness, and this is nearing zero now on the CPI print. So clearly it's struggling to stir demand despite a massive stimulus package from September, and that's being reflected in this tepid performance in Chinese stocks. But apart from what we're seeing on the mainland and in Hong Kong, it's really a day where there's not a lot of risk appetite. You think about how the Fed minutes signaled the caution from policymakers, a slowing pace of rate cuts. You have Biden, according to Bloomberg sources, planning further restrictions on chip exports that could affect firms such as Nvidia, and the uncertainty ultimately on what Trump's policies are going to mean for growth, but more importantly, inflation. So all in, not a great day for Asia stocks, a bit mixed, but the gauge of equities in the region moving lower. Christine?
Avril, thanks so much. That's Avril Hong in our Singapore studio. Well, the Biden administration is planning further restrictions on the export of AI chips from the likes of Nvidia and AMD in a final push to keep advanced technologies out of the hands of China and Russia. For more, let's bring in Asia Tech reporter Annabelle Jewellers. Annabelle, great to have you with us to talk through all of this. So there apparently are 3 tiers of restrictions here. Talk us through what we know.
Yeah, that's right. That's what we're hearing from sources because, of course, nothing's been confirmed just yet. But what we're hearing is that the US could be looking at introducing a 3-tiered system. And I think we've actually got a graphic we can show on this, but it sort of gets into the details as to which country is going to be in which group. So you can see here the countries that are in blue, that's the US and its allies. So you're thinking about Western Europe, Japan, Korea, Taiwan, Australia. These are the ones that are going to have unrestricted access to AI chips or chips that go into AI servers from the likes of Nvidia and AMD. The ones in pink, that is the Tier 3 countries. So that's quite evident there. It's Russia, China, Iran. They're the names that really stand out. They're going to face the most severe restrictions and essentially no access or restricted access to China's or the US's most advanced technology. And then in the middle, this is where it gets a little bit more confusing because it's the Tier 2 countries. And these are ones that are in Central, Southern America, large parts of Africa, India, across Asia. They're going to face some level of restrictions. And what we're hearing from sources is that they could be looking at essentially the US government telling these countries and the companies that are headquartered within them that they need to approach the White House and they need to demonstrate that they've already got some sort of negotiations or some sort of relationship with US officials already, that they're meeting certain human rights standards, for instance, or that they've got a credible plan for doing so, and then they can get greater access to compute power. But as I said, those tier 2 countries, they could face some level of restrictions. So that's the sort of 3-tier system. As I said, it could be announced by Friday, but nothing is clear just yet, or confirmed rather.
So what has the reaction been from Nvidia on this then?
So we saw the market reaction. It was a little bit lower in after-hours trading. Of course, the stock had been under pressure in the prior session anyway, but the company's put out a statement and it sort of just says essentially the US doesn't want to move too quickly here. Any policies that they enact have to be thought through, and they don't want to have the unintended consequence of slowing down US growth or capping its advancements either in tech. So that's sort of been the reaction from Nvidia. In terms of the market reaction today, again, we're sort of seeing mixed moves so far in the Asian chip makers that are exposed to this story. So it also tells you, okay, maybe investors are sort of waiting. Would this be something that President Trump back in the White House would continue with? The China chip makers, so that's an interesting one because they're actually rising off the back. And again, thinking about sort of second-order unintended consequences, the risk is if you limit US technology exports, China just continues to put more money into its own homegrown chip makers to advance its own reliancy in its supply chain, and you are actually seeing Chinese chip makers moving in the green today.
Yeah. Annabelle, thanks so much for all of that. That's Asia Tech reporter Annabelle Drewlers. President Biden has scrapped a planned trip to Rome as California races to contain fires fanned by hurricane-strength winds burning in and around Los Angeles. The wildfires, which have forced more than 100,000 residents from their homes, are the worst natural disaster to hit the city in decades. The offshore winds that have fanned the flames with gusts above 80 miles per hour are expected to last through Thursday, with no rain forecast over the coming days. Fed Governor Christopher Waller says he believes inflation will continue to cool towards the central bank's 2% target.
My bottom line message is that I believe more cuts will be appropriate. If the outlook evolves as I have described here, I will support continuing to cut our policy rate in 2025. The pace of those cuts will depend on how much progress we make on inflation, while keeping the labor market from weakening.
Well, let's bring in Manpreet Gill, CIO for Africa, Middle East, and Europe at Standard Chartered Wealth Management. Manpreet, great to have you with us on the set this morning. You heard there from Christopher Waller. We also got Fed minutes yesterday. None of that really changes the narrative around where Fed policymakers stand in terms of the path of interest rate cuts. But what about the bond markets? How do you think that they are looking at the dramatic shifts that we have seen higher in yields over the last 4 to 6 weeks? I mean, we're talking about a 10-year yield at almost 4.7%, a 20-year yield that did actually touch 5% yesterday.
Morning. No, some significant moves indeed. I think it's really about bond markets now reaching the point of trying to gauge just exactly how much further the Fed is likely to have to go in terms of rate cuts before they have to pause. And I think less so about inflation, but actually it's more about growth here. Because one of our views is that, look, economic growth, we were always in sort of the soft landing camp, but if anything, we think Trump's policies raise the chances that growth ends up being a little bit better than a soft landing outcome. But the opposite side of the coin of strong growth is actually more inflationary pressure. And while inflation might be going in the right direction, it just means the Fed may not need to cut quite as much to support growth while keeping a lid on inflation. So I think we're really in that how much part of the debate as opposed to any kind of big sort of change in direction.
Yeah, so when we look at inflation, it's clear that the bond markets are concerned about inflation. You're more concerned about growth, but what do you think that we will see in terms of price pressures as we go forward? And do you think that it's really a reignition of inflation that could potentially prompt a change in Fed policy going forward?
I wouldn't characterize it as a change, but I think it's much more focused on just exactly the speed and pace at which inflation continues to slow and just where it sort of starts to sort of, flatten out. And I think that's important for investors because allocators like us are ultimately trying to choose between, look, do you allocate more to bonds or equities at the most basic level? And I think why I focus so much on growth is that it makes it a much easier decision for equities and riskier bonds like high yield because you're more exposed to the growth side through earnings and credit quality. I think the debate on inflation means we're likely to see more episodes of markets trying to gauge, exactly where the right yield and inflation expectations is. So we'd see these sort of rebounds in yields as great opportunities to lock in income, particularly for investors who are still sitting on too much cash, where we think the yield still can fall further, but obviously not the biggest overweight. We think that you're better off in this environment, sort of even within bonds, focusing more on high yield, so more on credit risk as opposed to interest rate risk.
So talk to me more about that allocation, though. Stocks to bonds. How are you positioning as you consider Trump's policy playbook going into the year? I mean, what is your playbook for 2025?
Well, for us, it's an optimistic one from a growth perspective. I think we're overweight equities and overweight the U.S. within that. We think it's still very much a positive outcome from growth on balance. So hence, we still think on a one-year basis favoring U.S. equities, over bonds and cash still makes sense. I would caution that maybe, we're sort of going into this with a lot of recency bias. I mean, the last year or two have been quite fantastic. Equities delivered some fantastic gains and almost in a straight line. So perhaps, it makes sense to be prepared for a little bit more two-way movement, a little more volatility. But actually, that's a little bit more normal. And I think we're seeing a little bit of that today with a lot of one-sided positioning entering the year. And, we'd like to see more of this pulling back from it. But at the end of the day, we'd see that as opportunities to really position into that pro-growth scenario. We think it'll be bumpy, but on balance, we think Trump's policies will be positive for growth.
And if you're overweight U.S. equities, what do you think about valuations there? Because they are quite elevated.
They are elevated, no doubt. And we did quite a bit of work around, at what point does that become a hindrance? But it's interesting that, look, higher in most bull markets, valuations tend to go up and be on the elevated side. What's really key is do earnings deliver? And what we've seen in the past years is that as long as earnings keep delivering, actually, markets can still do quite well. It's just that we have to maintain a disproportionate focus on that. If you look back through history, when the cyclically adjusted PE has been in the ranges as we are today, actually about 2/3 of the time market returns have been quite strongly positive. So it comes back to that economic growth. As long as growth sort of stays on an even keel, translate through to earnings, then we wouldn't worry about it excessively.
Yeah, and we are really close to earnings season, so I guess we'll start to get answers soon. I want to ask you about gold, because we're coming off of the best year in a very long time, 27% gain. Goldman Sachs earlier this week pulled back its expectations for the metal to reach $3,000 an ounce this year. Where is your head at when you look at the gold market? Do you think 3,000 is in view for you this year, or are you the other direction with it?
I'd still say we were expecting higher prices, though much more moderately so compared to last year. For us, the drivers haven't changed. In our view, since 22, the big driver of prices has been rising central bank demand, which is more driven by geopolitics, and we don't really seeing that change directionally. I agree, repeat of last year's returns, looks unlikely unless, we're surprised by an outside shock. The other factor the role that gold plays in a portfolio is helping provide a bit of a buffer against all of what we discussed. The risk that we get a few inflation surprises, the risk that we get some volatility. So we still think it's a great overweight to have in portfolios, mainly based on central bank demand, but a good sort of buffer in a world where equities may not go up in a straight line. Yeah.
Manpreet, thanks so much for being with us. That's Manpreet Gill, who is with us today from Standard Chartered. He's with Africa, Middle East, and Europe, Standard Chartered Wealth Management. Coming up, we are live at the Malaysian Economic Forum 2025 in Kuala Lumpur. We speak exclusively to the Economy Minister next. This is Bloomberg. Welcome back to Horizons, Middle East and Africa. I'm Christine Burke in Dubai. The Malaysian Economic Forum 2025 is underway in Kuala Lumpur. The annual event is set to track the nation's government incentives and set economic goals for the year ahead. We're joined by Insight anchor Haslinda Aman, who is there now with a guest. Haslinda, over to you.
Well, Christine, this forum is being held against a backdrop of a turnaround in the economy. We're talking 5% growth from 3+ previously. And of course, if you take a look and if you've been tracking the Malaysian ringgit, what a turnaround. It was the best performer in Asia last year after a pretty lackluster start to the year. So quite a turnaround story for Malaysia. Let's get perspective on the economy. Rafizi Ramli, Malaysian Economy Minister, is with us right now. Minister, good to have you with us.
Thank you very much for having me.
That 5% growth can be exceeded this year, you think?
We are quite optimistic, but of course, we have to factor in some new developments. We have to wait and see the policies of the Trump administration, how it is impacting us. But I think it's on the back of very good fundamentals and the investments, especially into data centers and AI and semiconductors, that is going to continue in 2025, and we hope we can maintain in 2025.
You talk about that momentum, and of course that's pretty much driven on the back of a deal which we signed with Singapore, and that is the Special Economic Zone in Johor. There's a lot riding on it. We're talking about 100,000 jobs to be created, $26 billion to be added to the economy. When will we start seeing the results of that?
I'm hoping that we will begin to announce the first wave of global investments into JSSEZ as early as within 6 to 7 months. Of course, there will be parallel processes that we have to do. We will detail out the blueprints for each of the flagship areas. But the process to engage potential investors actually had started 1 year ago. So everything is happening in parallel, and if everything goes to plan, we hope to be able to maintain the momentum within 6 to 7 months, and that will set the pace of how quickly we are able to translate this into investments.
So where do you see that trickling down to GDP growth? And how much of a boost?
I think when it comes to GDP growth, it is already happening now, because as you pointed out, the interest into JSSEZ has been there since we announced it about a year ago. Of course, the first wave of interest was on property, because people start looking for place for investments. And once we firm out the next wave of global investments, I think you can start seeing into infrastructure, and usually the gestation period between final investment decision to operationalization is between 3 to 4 years. And this contribution to GDP will roll in phases, in fact, from last year all the way to 2030.
Minister, there are naysayers. They say that, when it comes to deals between Singapore and Malaysia, nothing really is set in stone. We've seen how the Speed Rail project was on again, off again. What's different this time around? Can we really see the fruition of this deal?
First, I think it's not apple to apple. We often cite the high-speed rail project as a source of skepticism for this. But that was a major infrastructure investment by both countries. There's always different view about that. JSSEZ is totally in a different context, because it comes from the realization of the complementary elements of Singapore and Johor, and that the synergy is a very good value proposition to the world. Now, even that idea is not new. It has been talked about for the last 2 or 3 decades. What is different this time around is that an agreement has been signed, and the commitment and the work process and the deliverables are actually cast in stone. So in that sense, both countries have committed. We believe in it, and the fact that both countries agreed to work and realize the first 50 projects in the first 5 years, and then 100 projects in 10 years, that means that there is a clarity in what has to be put onto the table by both countries.
Minister, a challenging macro backdrop, the mighty dollar, has smacked a lot of the emerging market currencies. How comfortable are you with the ringgit right now? I mean, some suggesting that it's currently undervalued.
I feel that it's undervalued.
By how much? What's fair value?
At the very least, we were optimistic from the second half of last year that it should remain around 4 ringgit 10, 4 ringgit 15 cent. But of course, a lot of things happen in the last few months, and we have to ride these uncertainties. But as I mentioned in the beginning, the momentum of the growth trajectory will be able to balance it out in the medium and long run. So while we know that ringgit, in our opinion, is undervalued, But I think there's a lot of light at the end of the tunnel if we stay focused on our growth projects.
The stability in the currency has, to some extent, been the result of the government and Bank Negara, the central bank, working together, implementing measures to ensure its stability. Do you expect those measures to stay in place?
That's the policy now, you know. It's not so much about just ringgit, managing ringgit fluctuations. It is also our economic design to make sure that we mobilize our capital better. And that's why we want to balance between the FDI and also our DDI, and also to scale up our GLCs and GLICs, our government-linked corporations, to ride and lead the next wave of investment at a higher value chain. So it all fits in, and I think it is something that we do with a lot of objectives in mind, not necessarily just to respond to the ringgit situation.
You talk about the FDI, and that's supported and building that momentum in economic growth in the country as well. In terms of 2025, what kind of FDI, what kind of growth are you anticipating? Where will that come from?
I think it's JSSEZ. We are hoping that will lead the next wave of growth, the ideal industry obviously is ones that revolve around advanced E&E and chips, because Johor, JSSEZ, as well as Klang Valley are the two centers of our data centers. And then the next wave of the industry is to build a more downstream industry that serves data centers. We are looking at more packaging, advanced packaging. We are hoping to build a local IC design industry. So I think that's going to be a lot of focus on that. But there will also be your traditional manufacturing and the uncertainties of the geopolitical situation and the trade wars means that it's common sense that global companies will look for ways to manage their supply chain, and Malaysia and Singapore is a perfect response to that, destination for that.
Minister, thank you so much for your time today. Minister Rafizi Ramli, Malaysia. Christine, of course, this is a conversation coming to you live from the Malaysian Economic Forum, and of course, he is optimistic that momentum can be built.
Haslinda, thanks so much for all of that. That's Insights anchor Haslinda Amin coming to us from Kuala Lumpur at the Malaysian Economic Forum 2025. All right, now let's get a look at some of the other stories that we are following this morning. Morgan Stanley has promoted 173 employees to the top rank of managing director. That's 12% more than last year, but lower than in each of the 2 years prior. Major U.S. banks have been bulking up promotions to top ranks, reflecting their strong performance and bright business prospects. The largest Wall Street firms in the past year have all outperformed gains for broader stock gauges. BlackRock has told employees it's cutting roughly 1% of its workforce, affecting about 200 people. The job cuts are part of the company's efforts to realign resources and come after it committed over $25 billion for takeovers to expand its reach in private market assets and data. The firm says the recent acquisitions will add another 2,000 roles this year. Jefferies Financial has reported profit that soared in the fourth quarter on a rebound in M&A and a surge in equity trading revenue, signs that the deal-making slump is coming to an end. Net income more than tripled after a 73% jump in investment banking fees and a near doubling of advisory revenue. A union representing U.S. dock workers has reached a tentative deal with port operators for a new 6-year contract, avoiding a possible strike. Bloomberg has learned the agreement guarantees union jobs when certain technologies are implemented, including the semi-automated cranes that had been a sticking point. The deal still needs to be ratified by the two sides. Right now, let's get a check of where the markets are as we head into the bottom half of the hour here. U.S. futures and European stock futures all under pressure. Remember, yesterday was quite a choppy day on Wall Street as we got a number of data prints coming through, and also we had a steep sell-off in the Treasuries market. 10-year yields, 30-year yields, actually Treasury yields across the board are coming back down this morning after the sell-off yesterday drove us to quite elevated levels. We'll talk more about that coming up. Still ahead, we speak to the CFO of Adnoc Logistics and Services. That interview at 8:40 a.m. Dubai time. This is Bloomberg. This is Horizons, Middle East and Africa. Our top stories this morning. Asian stocks fall after softer Chinese data and as traders look to Friday's U.S. jobs report. The latest Fed minutes show officials eager to slow the pace of rate cuts. And a Bloomberg scoop, the Biden administration is set to further limit exports of Nvidia and AMD AI chips in a final salvo against China's tech ambitions. Plus, Lebanese lawmakers will try to elect their first president in more than 2 years. It's just gone 8:30 a.m. across the Emirates. I'm Christine Burke in Dubai. Well, good morning again and welcome to the show here, the second half hour of the first hour of Horizons. Let's get a look at how these markets are shaping up. We are seeing U.S. equity futures come under pressure after a choppy day of trading on Wall Street yesterday. The S&P 500 and the NASDAQ both closed in different directions. But really, yesterday was not about the stock market. It was about the bond market. We had a broad-based sell-off for global bonds, not only in the U.S., but the UK, Japan, as traders considered the possibility that we will see inflation reignite, what that means for interest rate cuts. Also, of course, as traders look ahead to potential Trump policies and the potential for more government spending and more government borrowing. We also had a number of reports coming out of the U.S., including the ADP private employment report and jobless claims, which showed conflicting signals for the U.S. labor market. Didn't do too much to really dent confidence in the health of the labor market, but still is something to take note of. But note this morning that the 10-year yield to the 20-year yield, actually Treasury yields across the curve are coming back down after that sell-off. And that just goes to show why we are seeing an increase in bond market volatility. This chart shows you here two different gauges of bond market volatility. And you can see it's really the MOVE index that has seen the biggest pop higher over the last couple of weeks. We are now at the most elevated levels since November. Again, as traders just consider everything that I just mentioned. And the last thing I want to note is that U.S. bond markets close early today at 2 p.m. New York time. And U.S. equity markets are actually closed as there will be a celebration of former President U.S. Jimmy Carter's life today. The U.S. does have the funeral of Carter a bit later. Well, let's check in on how Asia currencies are faring now. Avril Hong is in our Singapore studio, and she's going to walk us through all of that. Avril, over to you.
Yeah, against the backdrop of those elevated U.S. yields, the mighty dollar, take a look at how Asia currencies are faring. They're pretty mixed, but EM Asia FX has really been bearing the brunt of the selling and the uncertainty surrounding Trump's policies. What are these policies going to mean for growth, for inflation? The Indonesian rupiah, the biggest decliner for a second day. The Malaysian ringgit managing slight firmness. You just heard from the Economy Minister talking about how he thinks the ringgit is undervalued. This week, it's also been gaining ground amid optimism of a special economic zone with its neighbor, Singapore. Of course, the yuan has been in focus. Today, we got data which cement the perspective of deflationary pressures in the country and how stimulus just hasn't been helping to prop things up. The PBOC is swooping in with support via the yuan fix, but also by announcing plans to issue record Hong Kong bills. And this is a way to kind of add to demand for the currency. So a mixed bag as far as Asia currencies are concerned, but mostly element of weakness in the face of greenback strength. Christine?
Avril, thanks so much. That's Avril Hong in Singapore. Well, let's keep the conversation going around markets now because the sell-offs that keep flaring in the bond markets are pushing yields toward key thresholds. That is amid escalating worries about elevated inflation, tempestuous politics, and swelling government debts. Let's get more from Bloomberg's MLive strategist, Mark Cranfield. So, Mark, we've seen some pretty significant moves. We are at very elevated levels, and there seems to be this narrative shaping up in the market that 5% is inevitable at this point in time. What do you make of that, and how significant is Treasuries nearing that 5% level for global assets?
Yeah, certainly. I mean, it seems to be a given that we're going to get very close, if not go beyond it. The 20-year yield in America has already touched 5% this week, although it backed off very slightly. The bond auctions have not been going that well in America, and obviously people are very concerned that the Fed is not going to be lowering interest rates for quite a long time. The minutes that came out this week were pretty hawkish, really, and you can see that people have dialed back their bets a long way. So certainly not much chance of rate cuts in the first half of the year, and maybe not even until we get to the third or even fourth quarter, depending on how the data plays out. Clearly, it's the inflation story which has come right back, and people are starting to extrapolate and think that once Donald Trump becomes president, he'll be introducing policies that will boost what's already a very strong economy anyway, and that will help to make inflation even higher. And then, of course, there's some talk, it hasn't yet been confirmed, of course, but they might even want to remove the debt ceiling. That's very worrying to the bond market, especially to the long end of the market. The curve is steepening as it is, and it would probably steepen a lot more if the talk gets serious about trying to remove that ceiling. So there are a number of factors pulling together that make the bond market very jittery. And it's not just in the US, of course, it's also spread across to other parts of the world. We may want to talk about the UK in just a minute.
Yeah, we definitely want to talk about the UK because we did see a sell-off there yesterday, some of the highest yields since 2008, I believe. What is going on with UK bonds? In our story, I was reading that there wasn't actually any news that seemed to trigger this. So what's happening?
Yeah, that makes it even more scary when you get a market which moves significantly without a clear rudder or a clear trigger for doing so. Then people really get spooked. And of course, when it comes to the UK, people can think back to there have been previous episodes. The most recent dangerous one was in 2022 when we saw bonds and the pound being sold off together. And it's exactly what we're seeing this week. People seem to be giving up on UK assets for the time being. And it's notorious, particularly in the long end of the UK bond curve, where liquidity is always challenging. So it's not difficult to push the market around significantly. We've seen that especially this week in the 30-year sector of the US curve, where yields have just been flying up. And demand suddenly just evaporates, and that's affecting the pound as well. So this is one of those cases where high yields are not supporting the currency at all. In fact, it seems to be making it worse. The more bonds fall, the more people want to sell the pound as well. And we've seen volatility start to go up very high on the pound, massive turnover in the options market. Yesterday, it was 5 times the normal average. So you can see the focus is very much on the UK at the moment. And really, the Bank of England is in a very tough spot. The market is telling them that the UK economy is going to a situation that is very dangerous. They probably should start to lower interest rates, and yet the inflation and the way that the volatility is here, the Bank of England will probably have to sit on their hands. It is going to be a very dicey time. So there would need to be a circuit breaker of some sort, whether it comes from the authorities stepping into the bond market or the Bank of England saying something. But for now, UK is very much in focus, and people don't like UK assets.
Yeah, Mark, I like the way you put it there. A dicey time. I think that is very appropriate. Mark Cranfield from our MLive team there on all that's happening in global bond markets. Well, back to the region now. Lebanese lawmakers will attempt this week to elect their first president in more than 2 years. Army Commander Joseph Aoun is seen as one of the 2 main candidates to lead a country battered by months of war. Aoun has the backing of the U.S. and Saudi Arabia, but will be challenged by IMF Middle East Director Jihad Azur. Dana Kreisch is Bloomberg's UAE Bureau Chief, and she joins us now. So, Donna, good to see you this morning. Can I first ask you, why has Lebanon been without a president for 2 years? Let's start there.
Well, political paralysis in Lebanon is not unusual, right? They always have vacancies in top government posts, and especially the presidency. Now, for the past 2 years, lawmakers couldn't agree on any name because Hezbollah and its allies have put forward Sleiman Frangiyi, their ally, as the #1 preferred candidate, and he did not gain the right significant majority to win in all of the 12 sessions that had passed. Now, this time around, it is different because Lebanon is coming out of a war with Israel, between Hezbollah and Israel. Hezbollah is much more weakened, and it seems a lot of the Lebanese, including those opposed to Hezbollah and its presence there, is trying to seize an opportunity. And you'll hear officials and Lebanese lawmakers talking about a historical opportunity here, a new chapter in Lebanon's history. So they want to seize the opportunity. Hezbollah is weaker. They want a more U.S.-backed, Western-backed president to first be able to implement the UN Security Council resolution, get Hezbollah out of the border near Israel. Secondly, start restructuring the economy, start on the reforms needed to unlock an IMF package. So this time around, they want to seize the opportunity. Hezbollah is weaker to set their own agenda.
So tell us about the candidates then, and if everyone is kind of mobilizing around this same momentum, is it more likely that we see this election bring a new president that forms a viable government and leads Lebanon to a pathway of reforms that put its economy back on track?
It seems there's more consensus this time around, and we've seen a flurry of diplomatic visits, right? We saw Amos Hochstein this week in Beirut. His first meeting in Beirut was with the army commander. Now, yes, he's following up on the ceasefire agreement with Israel, but again, there is the presidential election coming up today, and we saw the Emmanuel Macron's the French envoy, who is Jean-Yves Le Drian, was in Beirut this week as well. Foreign ministry delegation from Saudi Arabia came twice, and they're still in Lebanon. There seems to be an international consensus that is pushing for the election of Joseph Aoun, kind of saying this is the man that will get you the Western backing, that will unlock billions of dollars in aid, and most importantly, will get you the trust of Gulf nations, right? Saudi Arabia has been Lebanon's old benefactors, and they kind of drifted from Lebanon when Iran and Hezbollah gained that influence and continued to grow. So there's a void now. Hezbollah is weak, Iran is weak in Lebanon. There's a void to fill, and it seems the Gulf countries, the U.S., are trying to fill that quite seriously this time around.
All right, Didem, thanks so much for all of that. Sina Krish, Bloomberg's UAE Bureau Chief, and do note that election is happening today, so we will be tracking all of that and hopefully bringing you updates as the course of the day goes on. Well, still to come, Adnoc Logistics and Services secures up to $2 billion in financing to support its growth initiatives. We speak to the company's CFO, Nicholas Gleeson, next. This is Bloomberg. Welcome back to Horizons, Middle East and Africa. I'm Christine Burke in Dubai. Adnoc Logistics and Services has finalized a hybrid capital instrument worth up to $2 billion to support its growth initiatives. Now, $1.1 billion of that will be used to fund the acquisition of Navigate, a shipping and tanker operator. Joining us now is Nicholas Gleeson, CFO at Adnoc L&S. So, Nicholas, great to have you with us, and congratulations on just completing that acquisition of Navigate. This is an acquisition that will give you 32 tankers in 15 different cities. Certainly, this goes toward furthering the company's plans to expand globally. In the past, you have said that you're planning to do $5 billion plus in strategic investments in the years to come. So what is next after Navigate?
So thanks very much for having me on, Christine. And, we're thrilled to see the completion of this transaction. It's been a long time through regulatory process. This is a great business that we've acquired. They're great leadership in the business globally. They have an extremely strong position in the market in commercial pooling, as well as their tankers fleet, which we think is really well timed to bring into our large global fleet. What's next for us, and what we use the additional funds that we have available for, is continued growth. There's a lot of growth that we want to achieve domestically and internationally in the integrated logistics fleet, as well as the continued growth of our deep sea energy shipping fleet, predominantly through that Navigate platform. So a lot of growth ahead for us.
Yeah, so how specifically, or what investments specifically are you looking at that would help you achieve that growth? Where do you see gaps in your business or the need to make those investments?
For sure. So we've already announced a lot over the last 6 months. We've announced 340 years of contracted investments going out to 2048. So we have 9 very large ethane carriers coming in partnership with One Pipe Chemicals. We have 4 very large ammonia carriers. We have 8 to 10 additional LNG carriers coming on top of the 6 that we'd already announced at the time of IPO. We have the 32 tankers coming in together with the Navigate fleet. Then the specific investments we'll make beyond that, we have a large and growing jack-up barge fleet. We have a large and growing OSV fleet servicing the market here in the UAE. Qatar, servicing Saudi Arabia. We have assets now working in Africa and even into the US. So we have very significant international growth, and we'll continue to grow all of those asset bases. We also have an interest in growing our onshore logistics capabilities, which service those maritime logistics that we're handling here in the region.
Quickly, do you have a target for how much you intend to grow your fleet over the course of 2025? Is there one big number for you?
That's not really the way that we look at it, because those investments tend to come over such a long period of time. At the moment, it's very hard to order a new ship in some of the segments we operate in. There's so much demand for capacity in the shipyard. So, for example, the LNG carriers that we're delivering are a few years out. We've taken delivery of the first of the series of 6 at the end of last year, and those will continue 1 per quarter for the next 5 quarters. We then have, after that, the next phase of 8 LNG carriers coming on. So it's not just a single year growth project. In terms of what we'll invest in incrementally this year, I think there's likely to be a strong focus on that integrated logistics space, where the investments come on board more quickly. Probably a couple of investments to make in the shipping space as well, on top of what we've already announced.
Nick, you've said in the past that you plan to issue debt to help fund acquisitions, to fund your growth plans. Will you be tapping debt capital markets this year?
I would expect that we would, certainly within the next 18 months, be tapping debt capital markets. So when we bring on the Navigate platform, they have pre-existing debt financing of their fleet that we'll bring onto our books. We've built this hybrid capital instrument as essential as a base for the next round of financing that we do. So we're quite likely to draw fully on that. It's extremely well priced. It's an extremely efficient product, which serves us extremely well. And we have additional capacity to draw on that until the end of 2026. So the first port of call is very likely to be our existing senior unsecured debt, coupled with the hybrid capital instrument over the next 12 to 18 months, on top of the debt that we bring on with Navigate. And then as we move through that, we'll look at additional asset-backed debt financing to continue to deliver the growth that we've promised to the market.
Can you give us any ballpark figure of what kind of amount of bond we could see you bring to the market?
So it wouldn't necessarily be bond for us, but we're looking at a long-term 2.5 times net debt to EBITDA target. That continues even after the 2 billion raise on the hybrid capital instrument, which does not go against that net debt to EBITDA number. So our EBITDA for 2023 was 876 million. We guided to a low 30% increase. We haven't changed our guidance on that for the 2024 numbers. So that gives you an indication, 2.5 times that number is where we're heading in terms of our debt, our on-balance sheet debt raise.
Yeah, and let's talk about the Red Sea quickly, just as a final question here, because it wasn't that long ago that we were having conversations around different shipping attacks by the Houthi rebels at a frequent pace. That seems to have subsided a little bit. Have you seen tensions de-escalating a little bit in the region? How are you viewing shipping risks in the Red Sea at the moment, and do you expect that to change under the Donald Trump administration?
So we still have an extremely close watch on what we regard as the high-risk zone around Bab el-Mandeb and other areas in the region that where we see significant risk, and we avoid transiting those areas. So it's safety, health and safety of our personnel is critical to us. And it's not so much that the tensions have dissipated, but maybe they've left the news and there have been less incidents, but we still see the risk remaining. With the change under the Trump administration, I think there certainly is potential to see a more rapid resolution of geopolitical tensions internationally. We certainly hope that will be the case.
All right, Nick, thanks so much for your time. That's Nicholas Gleeson, CFO at Adnoc Logistics and Services. Coming up, Ghana's annual inflation rate climbs to its highest level in 8 months. We discuss the slimming prospects of an interest rate cut later this month. Next, this is Bloomberg. Welcome back to Horizons, Middle East and Africa. I'm Christine Burke in Dubai. Ghana's annual inflation rate climbed to its highest in 8 months in December, reducing the prospects of an interest rate cut later this month. Consumer prices rose 23.8%, up from a 23% reading in November. Joining us now is Bloomberg's Ondiro Oganga. So, Ondiro, break this data down for us. Why are we seeing inflation rising again after it was cooling down? And what interventions then might this prompt from the central bank?
Hi, Christine. So if you listen to the government statistician, he attributes the stubborn inflation to fluctuating food prices early along. Then you have the central bank also saying a stronger dollar, geopolitical tension and trade protectionism are some of the factors that have been affecting food prices and also energy prices in Ghana. And for this reason, the country missed its inflation target of 20%, with inflation averaging 23% in 2024. We saw the central bank during their last MPC meeting pause their cut cycle, holding rates at 27%. After cutting by 200 basis points in September, and inflation is expected to cool down to about 6 to 10%, but that's later on in the fourth quarter of 2025. In the interim, an economist tells Bloomberg it's too early to call what the central bank is going to do this year because, again, a new government has taken over power. The economic management strategy is still unknown, but also important to remember that Ghana is still under an IMF program, and part of those conditionalities is maintaining a tight monetary policy stance in order to manage inflation.
So you mentioned that the new government strategy is unknown. The new president that has come in, how does he kind of turn the fate around for this economy? What is the reality of his ability to do that?
Christine, during President John Mahama's inauguration speech, he almost gave us a glimpse into what his administration is going to look like and what he's going to do. He's saying he's ready to take the responsibility and solve Ghana's problems, and he's going to do that through creating a favorable business environment to attract investment in the country, promote efficiency and effectiveness in government, and also tackle corruption. But an uphill task awaits him. This is an economy that is crashing under the crippling weight of debt. Unemployment is above 20%, and also inflation peaked at 54.1% in 2022. And this is some of the factors that decided the election, and we saw that resounding defeat for the previous administration. And it goes to show that bread and butter issues are top of mind for the electorate. So the new president has a very short window to start turning things around, unless he too will lose goodwill with the public.
Ondiro, thanks so much. That's Bloomberg's Ondiro Oganga. Now, let's check in on what else we are watching this morning. Chad has averted a destabilization attempt after unknown assailants opened gunfire near the presidential palace in the capital. According to a government spokesperson, 19 people died in the incident. It's not immediately clear what sparked the shooting that lasted for about an hour. The UN is warning that rebels appear to be planning a long-term occupation of mineral-rich territories in Eastern Democratic Republic of Congo. According to the report, M23 rebels have been seizing Congolese towns with the help of Rwandan forces and setting up parallel administrations to control key mines and trade routes. Millions of people have been displaced since this rebellion restarted in 2021. In an effort to protect the country's dwindling reserves, the Bank of Botswana has increased the rate it charges commercial lenders to tap it for foreign currency. The move, aimed at discouraging banks from buying dollars, comes amid a prolonged slump in rough diamond sales that has strained the southern African nation's earnings. Well, markets have been on edge this week. That is definitely one thing that we know for certain. You can see that remains to be the case this morning. Futures in the U.S. and also in Europe pushing lower. U.S. Treasury yields are coming back down after jumping pretty dramatically yesterday in the wake of Treasury auctions, concerns about interest rates. We had Fed speak, also Fed minutes that came across. We do get bond markets closing early today in the U.S., and we also don't have U.S. stock markets trading today, just as there is the funeral for President Jimmy Carter. Well, coming up in the next hour, we are going to speak to Sumitomo Mitsui Banking Corp on the Fed and also on all of those market jitters that I just mentioned. Stay with us as Jennifer Zabazaza joins us from Johannesburg. This is Bloomberg.
This is Horizons Middle East and Africa, our top stories this morning. Asian stocks fall after softer Chinese data and as traders look to Friday's U.S. jobs report. The latest Fed minutes show officials eager to slow the pace of rate cuts. A Bloomberg scoop, the Biden administration set to further limit exports of Nvidia and AMD AI chips in a final salvo against China's tech ambitions. Plus, Lebanese lawmakers will try to elect their first president in more than 2 years. Good morning. I'm Jennifer Zabasaja in Johannesburg, where it's just gone past 7 a.m. Welcome to the second hour of Horizons Middle East and Africa. And as we can see within the markets, the risk-off sentiment still persists. Really, we're seeing traders having to navigate a number of factors, including the path of inflation. There's also concerns about government spending. We mentioned those FOMC minutes that we got on Wednesday. And of course, a lot of the uncertainty that is poised to come when President-elect Trump is inaugurated into office, But we are going to see U.S. cash stocks, closed today. We are seeing bonds trading, but closing early today in observance of former President Jimmy Carter's funeral. But let's just take a look at where markets are positioned right now. If we look at U.S. futures, marginally lower, as you can see right there, following a choppy session on Wednesday. We did see the volatility, though, not limited to just stocks, really spreading to the global bond market, not just in the U.S., also in the UK and in Japan. But the U.S. 30-year yield auction actually was awarded its highest result since 2007. Right now, we're seeing the U.S. 30-year at 4.91. I mentioned the bond market volatility. We saw it in the UK with gilt as well. The pound suffering a bit. Also, the rand really reaching a level we haven't seen in a number of years. Again, as we're seeing the volatility spread to EM more broadly. And just this chart for you, we're seeing jitters in the bond market increasingly spreading globally. We mentioned the UK, we mentioned Japan, and investors potentially seeing even more pain to come, again, with a lot of the uncertainty that is expected from President-elect Trump's policies. But let's check in on how markets in Asia are faring. There was some data that came out. Avril Hong, talk us through what you're looking at.
Yeah, we're seeing another day of risk off in the Asia Pacific. The region's benchmark is lower. Trading volumes are a bit higher than usual this time in the session. But overall, there's very little appetite for risk. You look at the Fed signals, you look at these concerns surrounding U.S. restrictions on chip exports potentially, and the China data, which showed you that demand is really still struggling in the Chinese economy despite stimulus efforts. So focusing as well on the Chinese markets as we return from lunch, because yesterday we did see a bit of a rebound or recouping of losses in the afternoon session, which kind of highlighted the specter of the national team. Today, back from lunch and looking pretty flat. Now, aside from this, we are also seeing Japanese stocks really underperforming today. The yen is also in focus, firming a little against the greenback as the dollar consolidates, but also after wage data out of Japan, which kind of backs the case for the BOJ. Green lights a rate hike, but still the base case is that we don't see one later this month from the Japanese central bank. This is what we're watching in the Asia Pacific today, Jen.
Thanks so much, Avril Hong in Singapore for us. We'll check back in with you in just a bit. Now, the Biden administration is planning further restrictions on the export of AI chips from the likes of Nvidia and AMD in a final push to keep advanced technologies out of the hands of China and Russia. For more, let's bring in Asia Tech reporter Annabelle Drewlers, who has been following this story. So, Annabelle, dig into some of the proposed restrictions that we're expected to hear in the waning days of the Biden administration.
Well, that's exactly it. I mean, it's coming out just in the final few weeks that President Biden is in office. What we're hearing possibly is that these new measures could be announced by Friday of this week. And what it would mean is essentially further restricting China's access to US chips that go into AI servers. What they're looking at proposing, what we're hearing from sources, is that this would apply to or create a three-tier system. So in the first tier, it's countries that are US allies. So you can see here the countries in blue on the map, but that's parts of Western Europe. In Asia, Japan Japan, Korea, Taiwan, there's Australia. So all of these countries will get unrestricted access. The countries in pink, which is tier 3, they're the ones that are the most restricted, essentially no access. But that's ones that, I mean, you can see there, but it's Russia, it's China, Iran, other names there. The countries in orange, this is where it gets a little bit more complex because they're the tier 2. And you're really talking about large parts of the world here, but they would have some restrictions. And so what happens in this case is that there is a cap on the amount of compute power they can access from the US, but they can apply to expand that cap if they can demonstrate these countries, these companies that are headquartered there in those countries as well in orange, whether they have already some existing relationships with the US government, whether they're meeting certain human rights standards, for instance, or they've got a credible plan to do so. So it's about sort of aligning intentions with the US government in order, as I said, to get better access to US technology.
And Annabelle, the reaction from a number of people was swift, including Nvidia, which objected to the proposal. Walk us through their reaction and what could potentially happen in their favor if this, if they're able to sort of push out some of these restrictions further.
Yeah, so the reaction from Nvidia, I mean, they're opposed to it, and then we've sort of heard this several times from Jensen Huang in the past, who's really sort of pledging for greater collaboration between the US and China. But that's the statement there. Essentially, they were saying any sort of last-minute rules restricting exports is going to be a major shift in policy. It reflects a similar tone to what we had in the Semiconductor Industry Association as well in the US. The market reaction has also been a bit interesting because we saw Nvidia a little bit under pressure in late trade. We saw the same for AMD. Today in Asia in the session, it's a little bit more mixed, the reaction. We're not seeing it, huge losses here. SK Hynix, for instance, a major supplier into Nvidia, it's still moving higher. I guess it also depends on, in the question of Nvidia in particular, but would the Trump administration continue with this sort of policy? That said, though, of course, there's huge bipartisan support for a more hawkish stance on China, and people in Congress, for instance, just last week wrote a letter to Gina Raimondo saying that this is really the once in a generation opportunity to restrict China's access and also to regain sort of these relationships with countries and companies away from the grips of Beijing.
Yeah, and fascinating it's coming during the week of CES when we did hear from Jensen Huang. Expect more on that later. Asia tech reporter Annabelle Drillers. Annabelle, thanks so much for your reporting. Let's turn to the Middle East now. The Israeli military says it has updated guidelines for media coverage of soldiers in the field to prevent their names and faces from being revealed. This comes just a few days after a Brazilian court ordered police to open an investigation into a visiting Israeli reservist for alleged war crimes. For more on this, Bloomberg's Dan Williams joins us now from Jerusalem. Dan, talk to us more about this media rule and why it's coming now.
Well, there's growing concern in Israel. It's at a low ball right now, but I think the Israelis realizing that this 15-month-old war, this regional war, could be open-ended and that this phenomenon could grow, are seeing a number of Israelis on normal travels abroad, Israelis who are perhaps soldiers on leave or civilians who did reservist duty in Gaza and elsewhere, seeing them at risk, vulnerable to efforts by pro-Palestinian groups to have them arrested on so-called universal jurisdiction. That's basically where a complainant comes to a magistrate in a country where this is possible by law to file allegations against someone else, in this case for war crimes or alleged war crimes. Oftentimes this is based on footage of that person that has been online, and it would appear that the Israelis are now trying, at least at the level of the military, in terms of authorized media coverage of the military, of specific soldiers, to restrict the amount of information available to the wider public in terms of identity, face, name, rank, and so forth.
And Dan, let's talk a bit about the ceasefire front. We have heard, of course, the Biden administration push their efforts. President-elect Trump also setting his own deadline for hostage release. Where are we at in the ceasefire front and potential negotiations there?
I would say here, and I would say it with complete caution, that the silence, especially of Israeli officials, around where things stand may speak volumes. There is an extraordinary level of control, messaging control in the Israeli government, including Israeli officials who as recently as 4 weeks ago, were sounding very upbeat about the prospect of a Gaza ceasefire and hostage releases. Now that has been muzzled. There are ongoing talks in Qatar, as you noted. Qatar is one of the two Arab countries mediating between Israel and Hamas. There is keenness, especially on the part of the Trump administration and actually the outgoing Biden administration, to see some kind of breakthrough here. Nothing solid to report yet. However, it would be certainly true that public pressure is building, not least as only yesterday the Israelis discovered the body of yet another hostage in the Gaza Strip and remains of who may be a second hostage. So there is really a humanitarian distress around the conditions of those remaining now 98 hostages in Gaza from the October attack of Hamas last year, and whether a deal can be put in place to get them out while they're alive.
All right, we'll stay tuned for that. Bloomberg's Dan Williams in Jerusalem. Dan, thanks as always for joining us. Now, still ahead, hear why Sumitomo Mitsui Banking Corp expects 2 Fed rate cuts this year, one in the second quarter and the other in the fourth quarter. More on their market strategy next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Fed Governor Christopher Waller says he believes inflation will continue to cool towards the central bank's 2% target.
My bottom line message is that I believe more cuts will be appropriate. If the outlook evolves as I have described here, I will support continuing to cut our policy rate in 2025. The pace of those cuts will depend on how much progress we make on inflation, while keeping the labor market from weakening.
Joining us now is Jeff Ng, head of Asia macro strategy at Sumitomo Mitsui Banking Corp. Jeff, great to get you on. So you and your team are seeing 2 Fed cuts this year. We just heard from Christopher Waller there. We're hearing some analysts saying no Fed cuts expected this year. Why do you believe we'll see 2?
I think there's a high degree of uncertainty that may come in throughout the year, because I think there's quite a lot of policy uncertainty that can come about the fall. Based on our base case, I think once there's some of this uncertainty from, let's say, the Trump 2.0, and then as inflation continues to dampen further, I think there could be scope for the Fed to resume its rate cuts. So for us at SMBC, we anticipate that could happen perhaps at the end of Q2 and another time in Q4. So the pace will be likely measured compared to 2024, where there were more rate cuts.
What do you see, Jeff, as the number one risk? Because we are seeing a number of investors really sitting on the sidelines until we get some clarity about the uncertainty. What's your take?
Yes, indeed. I think what's clouding market at this stage is the potential Trump policies that could come in, particularly on tariffs and immigration, because a tighter labor supply in the US and also higher prices from imports in the US are likely to be inflationary. So if inflation starts to rebound further in the second half of this year, it may mean that the threat towards rate cuts will be higher, and there could be less rate cuts than anticipated. And if inflation surges quite high levels, I think there could be even a case for rate hikes, even though that's a tail risk in our view.
Talk to us then about what that means for bonds. We were just taking a look at really the volatility that we saw on Wednesday, not just in the U.S., also in Japan, in the U.K. Do we continue to see this volatility persist?
I think definitely so. I think what we are likely to see is that the market volatility will be likely data-driven as well as news-driven. So any potential changes to policies, to tariffs, to relations, to competition. I think all these could affect the volatility going forward. For instance, for now, we don't anticipate that the 10-year US yields may surge much more than 4.70% for the rest of this quarter. But there's some likelihood that if there's some aggressive policies coming in from the Trump administration, I think that there could be some risk that it could surge as high as 5%. So I think in the long term, or in the short term at least, it's still a bit biased towards bull steepness as interest rates stay high.
So do you believe then the sell-off is a bit overblown right now?
I think there's some case for that, because what I'm anticipating and what we are likely to see at the start of the Trump administration is also tough opening gambits. So we could see huge numbers in terms of tariffs being announced. But I think there could be bilateral negotiations or multilateral ones that could lower the actual numbers that are going to be implemented. And there could be also some compromises, some cooperation along the way as well. So that's perhaps, in our view, the most likely scenario. So I think that could mean that the actual numbers actually come in a bit lower. But what we are concerned about now is the uncertainty. I think that's weighing on the volatility at this stage.
And Jeff, let's just end on currencies. I was speaking earlier about emerging market currencies here in South Africa and elsewhere, really seeing a lot of volatility, dipping to their lowest levels in quite a while. Where do you think China, South Africa, and some of the other proxies for EM stand then?
Sure. For the renminbi, we are neutral to bearish. I think we are seeing a top side of around 7.4 in the near term for dollar CNY, dollar CNH, with some slight easing perhaps by the PBOC and perhaps some allowance of a slightly weaker currency. I think some of the currencies in Asia that could underperform could include the peso, the Indian rupee, as well as the Korean won. This may be more vulnerable towards some of the potential volatility that we may see in the first quarter. But nonetheless, I think if the dollar starts to weaken in the second half, there could be scope for some of these currencies to outperform. So we are bearish on the Thai baht, for instance, but we are more bullish in the 12-month period.
Jeff Ng, head of Asia macro strategy at Sumitomo Mitsui Banking Corp. Great to get your insights on this morning, Jeff. Thanks so much. Now, coming up, Lebanese lawmakers will attempt to elect a first president in more than 2 years. We'll have the details next. This is Bloomberg. Welcome back to Horizons, Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Now, Lebanese lawmakers will attempt this week to elect their first president in more than 2 years. Army Commander Joseph Aoun is seen as one of the two main candidates to lead a country battered by months of war. Aoun has the backing of the U.S. and Saudi Arabia, but will be challenged by IMF Middle East Director Jihad Azur. Donna Quraish is Bloomberg's UAE bureau chief, and she's joining us now from Dubai. Donna, talk to us about why this took so long to elect a president and really the significance of this election.
Good morning. Yes, well, political paralysis is not unusual in Lebanon. They always usually have vacancies and vacuums in top government posts. But this time around, it took 2 years because Hezbollah and its allies were insisting on a single candidate, and the Lebanese and other lawmakers couldn't agree on or couldn't come to a consensus on a single candidate. Now, this is more urgent this time around after the war between Hezbollah and Israel, and now Lebanon is, of course, gearing up to elect a new president. This is crucial today because Hezbollah and its allies, and consequently Iran, is much weaker now in Lebanon. Its influence has definitely shrunk. And with Joseph Aoun's election, who is, likely election, who is backed by the U.S. and Gulf nations and France, it is more of a shift in the balance of power in the country towards the U.S. and the West. So Iran is getting weaker there, and his election would mean a shift in the influence of Iran and the balance of power.
And Donna, we mentioned the leading candidate there, but are there other candidates of significance that potentially the markets are paying close attention to?
It seems yesterday many of the lawmakers and the parliamentary blocs came out and said we want to vote for Joseph Aoun. And while IMF's official Jihad Azour's name was actually being circulated around, especially with Christian groups, it seems they are now going to vote for Joseph Aoun. We saw U.S. envoys. We saw the French envoy, Jean-Yves Le Drian, who's still in Beirut. We saw a Saudi foreign ministry delegation coming to Beirut twice this week. There was kind of a push for Joseph Aoun, according to local media reports and our sources there. So it seems Aoun has this international backing that would help him get elected and also implement the needed reforms for, bank restructuring, central bank restructuring, begin talks with Eurobond holders. And most importantly, given that he is the army commander now, he will be able to implement the UN Security Council resolutions that would keep Hezbollah away from the border with Israel. And this is crucial to maintain security on that border and prevent a future conflict between Hezbollah and Israel.
All right, we'll watch for the developments of that. Donna Quraish, Bloomberg's UAE bureau chief there in Dubai for us. Donna, thanks so much for joining us. Now, let's take a look at some of the other stories we are following this morning. Morgan Stanley has promoted 173 employees to the top rank of managing director. That's 12% more than last year, but lower than in each of the 2 years prior. Major U.S. banks have been bulking up promotions to top ranks, reflecting their strong performance and bright business prospects. The largest Wall Street firms in the past year have all outperformed gains for broader stock gauges. BlackRock, meanwhile, has told employees it's cutting roughly 1% of its workforce, affecting about 200 people. The job cuts are part of the company's efforts to realign resources and come after it committed over $25 billion for takeovers to expand its reach in private market assets and data. The firm says the recent acquisitions will add another 2,000 roles this year. Jefferies Financial has reported profit that soared in the fourth quarter on a rebound in M&A and a surge in equity trading revenue. Signs that the deal-making slump is potentially coming to an end. Net income more than tripled after a 73% jump in investment banking fees and a near doubling of advisory revenue. And finally, a union representing U.S. dock workers has reached a tentative deal with port operators for a new 6-year contract, avoiding a possible strike. Bloomberg has learned the agreement guarantees union jobs when certain technologies are implemented, including the semi-automated cranes that had been a sticking point. The deal still needs to be ratified, though, by the two sides. And a quick check on markets before we go to break. We did mention that U.S. cash stocks are closed today. Bonds, meanwhile, are going to trade but close early. But a bunch of red on the screen right now for S&P futures after the choppy day that we saw on Wednesday, really globally, and also for Eurostock 50 futures. Now, coming up, we have more on the global bond sell-off. Stick with us. This is Bloomberg. This is Horizons Middle East and Africa, our top stories this morning. Asian stocks fall after softer Chinese data and as traders look to Friday's U.S. jobs report. The latest Fed minutes on Wednesday show officials eager to slow the pace of rate cuts. A Bloomberg scoop, the Biden administration set to further limit exports of Nvidia and AMD AI chips in a final salvo against China's tech ambitions. And wildfires tear throughout parts of California, killing at least 5 people and forcing more than 100,000 residents to flee. It has just gone past 7:30 a.m. in South Africa. I'm Jennifer Zabasaja in Johannesburg. Welcome to Horizons Middle East and Africa. And as we mentioned, there is a lot for traders to be assessing. We mentioned those FOMC minutes that we did get on Wednesday. Questions about the path of inflation, also government spending, also what is pending with Trump 2.0, as we heard our guest saying earlier. But today we are seeing U.S. cash stocks closed in observance of Jimmy Carter's funeral. Bond markets will be closing early. But let's just take a look at where markets are positioned right now. Wednesday was a choppy day for markets, especially in the U.S. We are seeing U.S. futures marginally lower. And we mentioned the choppiness and the volatility extended globally, at least in the bond market. We're seeing both the UK and Japan feeling the effects of a bit of concern. But right now we have the U.S. 30-year at about 4.91. We did see an auction that went off on Wednesday, awarding the 30 yield with its highest result since 2007. I also have the pound dollar cross on the board. Labor government spending, clearly a bit of concern. We mentioned the sell-off in gilt, but also the pound taking a bit of a hit there. And here in South Africa, we're paying close attention to the rand, normally seen as a proxy for EMs. We also mentioned China currencies. Right now, we're seeing it back off slightly from the weakness that we did see on Wednesday when it breached the psychological level of 19. But we'll continue to watch really how that goes going further. But let's just dig into more of the jitters that we're seeing. The jitters in the bond market increasingly hitting globally, as mentioned. And as this chart is showing, investors, some investors at least, are expecting even more pain to come as this uncertainty really persists and really as the President-elect Trump's policies remain in play and remain a little bit more of a blurred area for investors. But let's check in on the yen with Avril. We mentioned some of the data that we got, at least in China. But Avril, take us through what we're watching for in Japan.
Yeah, amid those elevated U.S. yields, the greenback strength, the Japanese currency is really among those in the region that have succumbed to the resilience of the U.S. dollar. And it's a story of yen weakness. I mean, at the heart of the matter is really how traders are not convinced that the Bank of Japan is serious about tightening, about hiking rates later this month, especially after a really dovish presser from the central bank governor last month. And this is despite data which backs the case for the BOJ to tighten. You look at how base wages data out today, they climbed by the most in more than 3 decades. And part of this positive signals on wages and a firming economy that policymakers want to see before they kind of take their foot even more off the stimulus pedal. And adding to the dovish outlook for the BOJ today, how it showed this assessment of domestic economies, leaving that unchanged. I've just been talking to our colleague Mark Cranfield, and he says that the last chance for the BOJ to signal to the markets that the meeting this month is going to be a live one will be the middle of the month when there's a big speech due. But otherwise, a story of yen weakness is really not far from levels which last drew intervention, Jen.
Well, thanks so much, Avril Hong in Singapore for us. Now it's our turn to talk to Mark Cranfield. Listen, the sell-offs that keep flaring in the world's bond markets are pushing yields towards key thresholds. That's amid escalating worries about elevated inflation, tempestuous politics, and swelling government debts. Let's get more from Bloomberg MLive strategist Mark Cranfield, who is joining us now. So, Mark, talk to us about how significant it is if we actually see treasuries continue to flirt with this 5% level.
Well, it's pretty big in the context of where yields have been. So if you think back just a couple of months, we seem to be on this trend of global yields being led lower, particularly by what's happening in the US. The Federal Reserve has started to cut interest rates. People were expecting quite a lot more. Then the US election changed everything, and people are now more worried about inflation coming back and causing problems for central banks, particularly for the Federal Reserve. And we've just had the minutes come out this week, and they are pretty hawkish from the Fed. And that's one of the reasons why people are dialing back on the potential for further cuts this year. Probably no chance in the first half now, and maybe not even until the fourth quarter, depending on the data and what policies are actually enacted by the new president. So it's getting pretty hot in the bond market, as you say, and it's spilling all out over the world. We've already seen the 20-year yield touch 5% already. It came back slightly yesterday, but it looks as though there's a decent chance we will go. There's a lot of data next week in the US as well, and we've got the jobs report tomorrow. So the 10-year yield may well get close to 5%, if not go above it. And all of that is pressurizing not just the US dollar, equity market starting to feel it as well. Of course, it is spilling over to the rest of the world. And our favorite subject, UK markets, which I think you're going to talk about right now.
Is that your favorite subject, Mark? Listen, it's interesting, though, what is going on in the UK. Many people are comparing this to what we saw under Liz Truss just a few years ago. Is it a similar story there about government concern about government spending? And is it actually a comparison to what we saw under Truss?
Well, as you say, certainly people are in the market already starting to think about that. Bloomberg have just pushed out a big story as well from Martin Wheel, who used to be a Bank of England governor himself. He was one of the rate setters just a few years ago. And he says it's more like 1976, which is a really scary scenario, because that's when Britain went to the IMF cap in hand to try and get a bailout because things were so bad. Everything was getting out of control in the UK at that time. Spending had gone too crazy. There was no confidence at all. Inflation was very high and the pound was getting crashed. Very similar situation to what is starting to build up here. The UK bond market is notoriously illiquid in the long end of the curve, particularly around 30 years. We've seen it getting beaten up really severely. People can step away very quickly. And this time round, high yields are not supporting the pound at all. In fact, it seems to be a spiral where the more bonds go down, the more the pound suffers as well. So if it's really anything like 1976, people really need to get worried, because that is a very dangerous time at all. The next few weeks are going to be really important. Bank of England have got a very tough job here. They would probably like to lower interest rates, but in this scenario, it'll be way too dangerous. They also will be concerned that with the wage hikes to come, inflation could push up as more. There's no question about UK assets going to be right in the forefront. High volatility, you can see it in the options market. Yesterday, 5 times the usual average of volumes in the pound options market. It's a pretty crazy time. It hasn't finished yet.
And pound dropping to its lowest level in 9 months, as you mentioned there. Mark Cranfield from our NLive team. Mark, thanks as always for joining us. Now, let's turn back to the U.S. We mentioned the fires. Uncontrolled wildfires are still burning throughout parts of California, fanned by hurricane-strength winds. The fires, which have forced more than 100,000 residents from their homes, are the worst natural disaster for Los Angeles in decades.
I am making sure that we leave no resource untapped. Firefighters are now on scene from across the state and across the country.
Let's get the latest from our LA Bureau Chief, John Gittleson, who stayed up for us. John, it's concerning pictures that we're seeing coming from Los Angeles. Talk to us about the situation where it's at right now.
Yeah, well, my wife and I, we were just forced to evacuate from our home in Hollywood because a new fire popped up there. And yeah, these fires keep popping up. That's the thing. It hasn't rained in 8 months. And the wind was extremely strong. It's died down a little bit. But once a fire gets started, it's got a lot of grass, a lot of brush to burn, and it's very hard to stop.
So, John, I mean, we talk about a lot of the concern here is centered around the Santa Ana winds. Talk to us about how this has gotten an even more concerning situation over the past few decades.
Yeah, well, droughts have gotten a lot worse and temperatures have risen. There's always been fires for, as long as people have been in Southern California, there have been wildfires. But this is January, and usually January is the peak of the wet season. And now it hasn't rained since April significantly. So all that stuff that grew last year when it rained a lot is totally dried out and makes perfect kindling. So, the cycle of weather that's changing, climate change, is really causing this problem to get a lot worse.
John, do we know the extent of the damage at this point in time? And hand in hand with that question is also the question of insurance and whether or not insurance is going to step in to support those people who have lost their homes.
We don't know the extent of the damage because things are still burning. There was one estimate over $50 billion, and that was just based on one day's analysis. Insurance companies, a lot of them have pulled out of California because they have so much concentration. I think the state ultimately is going to have to somehow step in and, help bail people out.
What does that look like, John? And especially, this has already become politicized, this tragedy that we're seeing. What does bailing people out look like for the state and also nationally, potentially?
that's part of the problem. I mean, where's the money going to come from? Who's going to pay the insurance? I mean, already California is one of the least affordable places to own a home or buy a home. And so insurance rates are definitely going to go up. There are places where insurers don't want to cover houses because these fires can be so bad. And so there's going to have to be a lot of cooperation between insurers and government to make sure that the insurers can be reinsured.
Well, we are looking at live pictures there. Hopefully, John, you and your family stay safe, and the other residents of California. But appreciate your time, LA Bureau Chief John Gittleson there for us. Now, coming up, we'll discuss China's economy and some of the data that we got earlier today. Stick with us. This is Bloomberg. Welcome back to Horizons, Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. China's consumer inflation has weakened further towards zero, decelerating for a fourth straight month in a setback for government efforts to stamp out deflation and revive demand by injecting stimulus into the economy. For more on this, let's bring in Bloomberg's John Liu, who is joining us now from Beijing. So, John, talk to us about why CPI has continued to be so weak despite a number of measures that the government has tried to take to avoid this.
Well, here's a simplified sort of answer to that, which is there was a housing bubble in China. That bubble burst. Home prices have fallen for basically 3 years. That's convinced a lot of households and a lot of companies that instead of spending money, instead of investing, they'd rather save their money. They'd rather spend that money paying off their debt. And as a result, companies have had to cut their prices on goods and services to try to get what business they can. And the government has done a lot to try to stabilize the property market, to get people to spend again, but it has not been enough. And there have been limitations. So I think the thing that has stood out recently the most is the currency. You talked to Mark about with rates in the U.S. staying high, the dollar being strong. The central bank here in China has to, it should be cutting rates and loosening policy, but at the same time, it has to keep an eye on the currency because it's worried that if it loosens too much, it'll put a lot of pressure on the yuan.
Well, and also, John, has to keep an eye on what potentially Trump brings to the market there. What more can policymakers then do?
So this week, Beijing has introduced new subsidies to try to get people out to buy washing machines, home appliances, water purifiers. They're extending subsidies for electric cars to get people hopefully out and buying cars again. But as you mentioned, with Trump coming back in, with the threat of tariffs, with interest rates and the currency being weak, all of these are big headwinds. And so the government is doing what it can. Whether or not it actually works, I think, is still an outstanding question.
What will be contingent on it working, John?
So I think the pace with which new stimulus measures have been rolled out since the end of last year, the magnitude of those measures, they suggest that the government, there is a greater urgency within the government to try to find something that works. And much of that has to do with the idea that if they allow deflation to set in, it'll get harder and harder to fix the longer it goes on. And so there is an urgency to try and get something done as soon as possible. But again, with all the headwinds that they're facing, it's hard to say whether it'll work.
Yeah, we'll pay attention to that. Bloomberg's John Liu in Beijing. John, thanks so much for your reporting and for joining us. Now, still ahead, Ghana's annual inflation rate actually climbs to its highest level in 8 months. We're going to discuss the slimming prospects of an interest rate cut later this month. That's next. This is Bloomberg. Welcome back to Horizons, Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Ghana's annual inflation rate climbed to its highest in 8 months in December, reducing the prospects of an interest rate cut later this month. Consumer prices rose 23.8%, up from a 23% reading in November. Joining us now is Bloomberg's Indira Oganga, who is in Kigali for us. So, Indira, why is inflation rising again after cooling down? And what are the interventions that potentially we can expect to come?
Hi, Jen. So the government statistician is attributing the stubborn inflation to fluctuating food prices. You also have the central bank saying stronger dollar, geopolitical tension and trade protectionism are some of the factors that are affecting prices of food and also prices of energy. And because of this, we saw the government miss its target of 20% with inflation averaging 23% in 2024. Also in November, during the previous MPC meeting, the central bank paused its cut cycle and held rates at 27% after cutting by 200 basis points in September, leading to 2025. Inflation is expected to cool down to about 6 to 10%, but that is in the fourth quarter of the year. In the interim, leading to the next MPC meeting later on this month, the central bank has to consider a couple of things. One is the rising inflation, and Goldman Sachs says they expect delayed resumption of a cut cycle. They also have to consider the fact that a new government has come into power, and we have to wait and see what the economic management strategy is going to be. But also important to remember, Ghana is under an IMF program, and part of the conditionalities is maintaining a tight monetary policy stance to manage inflation.
And you manage the new government in power. We saw John Mahama re-elected as president, just sworn in this week. What can he do to turn this reality around?
Jen, he gave us a glimpse of what his administration is going to look like during his inaugural speech. And he says he's ready to take the responsibility and solve Ghana's problems. And he'll do this by creating a favorable business environment to attract investment into the country. He will promote efficiency in government and also tackle corruption. But an uphill task awaits him, because this is a country that is crashing under the crippling weight of debt. Then you have high cost of living after inflation peaked at 54.1% in 2022. And youth unemployment is really high, with overall unemployment being over 20%. This is some of the issues that decided the election, and we saw that resounding defeat for the previous administration. So President John Mahama has a very short window to start turning things around, unless he loses any goodwill that he has with the people.
Yeah, exactly. And that's what it all comes down to. Bloomberg's Indira Oganga in Kigali for us. Indira, thanks as always for your reporting. Now, in the U.S., the outgoing chair of the Securities and Exchange Commission says there's more still to be done in regulating the crypto market. Gary Gensler plans to step down on January 20th when President-elect Trump is sworn into office. He spoke with us and told us how he feels terrific about what he's achieved, despite criticism from Trump and his supporters.
It's a great privilege to be in a role like this. I'm the 33rd chair, and it's a big country. A lot of people could do this job. So I start with, it's just such a privilege to be here, and thank you to Joe Biden for asking me to do it. But what's remarkable about this role is it oversees the $120 trillion capital market, which touches everything in our economy, because you've got to raise money for most of what we do in our economy, and people save. So I feel terrific. You ask about the attacks and things like that. That's what public policy is about. You walk into this central square and you debate these important things for 330 million Americans. I've worked over the years with Hillary Clinton on a number of campaigns, and I remember Hillary saying once, like, if you're not willing to be attacked, you can't go into the public square and debate policy. And so I think it's part of our great democracy.
I look at who is inveighing against you and who's throwing that invective, and it's the president-elect, it's the world's richest man. Does it feel different to you than what you, I'm sure, experienced after the global financial crisis when you were at the CFTC? Has the atmosphere, has the environment changed for regulators like yourself?
Well, I think it does change. What we do here at this great agency is look out for everyday Americans, people just trying to save for a better future and try to move through things that help them, like we've done, like even shortening the settlement cycle from 2 days to 1 day. Might sound geeky behind the scenes, but it means you get your money 1 day faster, for instance, or getting privacy notices. There was no federal rule that you needed to get a notice if your data was hacked. And we put in place some rules to do that. So we're looking out for everyday Americans, trying to lower the cost of the markets to trade stocks, to trade the bonds. But it doesn't surprise me that then there's some in the middle of the market. They're called brokers, they're called dealers, they're called intermediaries, stock exchanges, who they like their business model. And if we're changing the rules to benefit everyday Americans, they might have thoughts on that and object. And that's part of the process.
That was the outgoing chair of the U.S. Securities and Exchange Commission, Gary Gensler, speaking with Bloomberg's David Gura. Now, before we let you go, let's take a look at where markets are positioned ahead of the trading day. We mentioned in the U.S., U.S. cash stocks are closed because of former President Jimmy Carter's funeral. We are going to see bonds, though, trading until about 2 p.m. local time. But right now, a bit of red on the screen for Thursday for futures. Wednesday, definitely a choppy session for both stocks and for bonds right now. S&P futures down marginally. Also, Euro Stock 50 futures largely unchanged, but still we'll wait to see what happens. And we were speaking to Mark Cranfield earlier about some of the concern in the UK and also more broadly for currencies. And so we'll wait to see how the markets trade in today's session. Let's just take a look at bonds, though, as well, because we mentioned that there was volatility not just in the U.S., but also in Japan and in the U.K., really reflecting for many people, seeing some echoes to what we saw under Liz Truss. And let's just finish on cocoa. We were speaking earlier to our colleague Ondiro about John Mahama and the new president over there. But we're also watching a lot of activity in the cocoa market that we'll bring you later today. But that's it for Horizons Middle East and Africa.